Hi, it's Helen Tarrant. Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and I'm here just walking around the CBD in Sydney. I've just come out of a meeting, and I just thought I might do this quick video to show you about how commercial valuations is coming along in this day and age after COVID. So I'm in the city, and we can see that there's lots of people about, and of course there's lots of commercial premises. So, and some of these commercial premises are actually retail premises. So, and we know that there's been people who haven't visited retail premises for a while, and that they're not the flavour of the month. But how does that impact on valuations going forward? Now, during COVID, some of the different things that happened in valuations is taking into account what happens if your tenant had an incentive as part of the COVID plan. So as you know, that there was a mandate of 50% waiver and 50% basically being paid back into a payment plan, and an extension on your leases. So some people may mean that their leases, if they were about to expire during COVID or right after COVID, that they had to extend that lease by another 6 or 12 months, so or potentially 24 months, by the fact that they will then have a payment plan. So how does that impact when valuers come through the property? So if you are the purchaser of this property and you have a valuer that's about to value this property, and say, for example, we're looking at either let's say a Priceline, or we're looking at a nail bar, or looking at a restaurant or a cafe, or your pure retail where they're selling jewelry, or they're selling books or stationery, or any of those things. Now, one thing that normally happens is you take the lease and you work out the net return. So let's say you have a lease and the tenant's paying $20,000 net, and the yield is 5%, and then you come out at the other end at the valuation what the property is worth. But what happens during COVID? Now the rent has changed, because your tenant is paying the $20,000 plus potentially an extra $200 a month because they're paying back their COVID loan, or their COVID rent that they had been waived before, or they had the discount for. So what that would naturally take into consideration is we're going to take into consideration the impact of if the future COVID was going to happen, so another pandemic or something similar to that, or alternatively, what would happen if your tenant is able to meet their rent obligations if the rent went up. And also then we look at some of the modelling regarding if this tenant was to leave, how risky is your premise in terms of getting another tenant. So you put all those three risk factors together, and then you come out the other end, and what you'll find is that the valuation often comes in a lot more conservative than what it was potentially back 24 months ago. And you'll find there's certain locations that you are going to be more impacted as part of this risk profile. So that would be, if you are in a metro CBD area, you would actually be more impacted by it and by the valuation. So the valuation may come in less, and if you were an office space on second level, or your retail space that's at the back of an arcade where there's less exposure, you are actually going to might likely have a lower valuation, because the risk factors are going to be higher for you to be able to re-tenant that property and get the same level of rents, because we've got the downward pressure on rents. So those are the things that are taken into consideration during those valuations. But normally the normal valuation would apply, and you will get an accurate comparison of whether your rent that you're charging your tenant now is comparable to the rent that you could potentially charge a new tenant coming into the property, and also then what potentially you could sell that property for in the market. But remember, just because one value the property at a certain point, at a certain value, does not mean that 3 months down the track, 6 months down the track, or a year down the track, that property is going to be at the same value. It could be more, it could be less. And most of the times things change and values change. And especially if you're in a retail property, things definitely change in terms of the tenant mix and what's happening in the area. It actually means that there's potentially an increase in your property value in a short space of time. So while I can't give you definitives of exactly what your property will be worth in this valuation at this current time, some of the things to really think about when you're going to valuation, and this is especially the case when you go to a time when you're refinancing your property and you're looking at something, you're looking at the idea of refinancing, pulling the equity out and going again. It's worthwhile to actually look at the timing of it. So Right now, for example, you don't want to be in the middle of a lease negotiation with your tenant or anybody else because there's downward pressure on rent. Likely, if you can hold on refinancing for maybe another 6 or 12 months while the market picks itself back up in terms of rent and in terms of some of the factors of COVID and the conservativity of the bank, you are maybe in a better position to pull out more equity out of your property as well. So because of those things, you may want to consider in terms of your timeline an exit strategy of your commercial property. But overall, when you're looking at valuations right now, the banks are doing it very, very conservatively. They're looking at the risk factors of how exposed is your property to COVID and potential other environmental as well as financial impacts on the business. So if you're in the Metro CBD, they're going to be looking at, can you re-tenant that property? What is the access in terms of parking and clients and in terms of your operations? And is the rent on par with everything else considering the environment? So there's a downward pressure on rent, and say someone around you, if they were going to get into a new premise now and they're going to get 40% less in rent, then they will be benchmarking that against your property and what your tenant is paying. And if your tenant is paying too high above market, they'll pull back that rent and then value you based on the current market rent. And that's what you're most exposed to at the moment if you were to go into a valuation now with a commercial premise. So moving forward, how would you combat that? Well, the best thing to do that is to keep your sitting tenant there. Make sure that your tenants are happy and provide them with some incentives to potentially sign a longer lease, because there's a value on a longer lease term in this current market than anything else. So that means that even if you're getting above market rent, if you could show a longer lease term, you are going to get a much more favorable valuation. So in that case, talk to your tenants again, maybe offering some incentives, get them to sign a new lease with a long-term lease, maybe potentially extending by 12 or 24 or 36 months if you can of their current lease, by giving them some rent-free or half rent or exempting them from paying outgoings is an option. The other thing is to do see if your tenant has the capacity now to actually pay off their COVID loan. So rather than it being broken up over the next 12 months, perhaps offer them an incentive. So let's say they owe you $20,000 and they're going to pay that off by extra $2,000 a month for the next 10 months. Well, instead of that, maybe say offer them $15,000 for them to actually pay out their COVID loan now to you, or the COVID repayment, and you could start on a brand new lease. This way, if you do have a valuer come through, they're not assessing the tenant as if they still are paying back a debt. They're actually assessing the tenant come in as a brand new tenant with a brand new lease in this current conditions, and therefore everything is reflecting current market conditions, and they're more insulated against potential risks that's coming into the market, therefore more likely to get a much more favorable valuation. So, but if you are, and I know the valuations is a bit hard to pick, and there's lots of variables of what's right and what's not right, and how you can prepare your property for that revaluation. But if you do want me to run through some property deals with you, or if you really want to find out if this commercial property that you're thinking about or future commercial properties is right for you, reach out to me at helentarrant.com, hit the bell, subscribe, or just directly email me at helen@commercialpropertycashflow, and I'll jump on a strategy call with you and we can work out the exact strategy, the exact property that you need to get to financial freedom through commercial property. So until next time, bye for now.